Hi everyone, today we'll be going over accounts, May June 2022, paper 2-3, question number 4. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 4 is of 30 marks, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. G Limited manufactures products at 2 factories, and the company uses marginal costing. So the first part of this question, we need to state 4 assumptions used in break-even analysis. Whenever we're talking about break-even analysis, we only talk about a single product. So our first major assumption is that a single product is being made. Let's write it down. A single product is made. Secondly, there are 3 assumptions for 3 variables to be constant. So the first one is total fixed cost. Our assumption is that the total fixed costs remain unchanged. Let's write it down. Total fixed costs remain unchanged. Similarly, the second variable is variable cost per unit. So the variable cost per unit also remains constant or unchanged. Let's write it down. Variable cost per unit remains constant. Alright, then the last one is the selling price per unit. So our last assumption is that the selling price per unit does not change. Let's write it down. Selling price per unit does not change. Alright, this concludes the first part of this question. Now we can move to the second one. For the second question, we need to state the formula for calculating the margin of safety in units and sales value. Alright, the first one is the margin of safety in units. We know that margin of safety in units is just the difference between sales value and the break-even point. So that's just going to be sales in units minus the break-even point in units. Secondly, we need to write the formula for margin of safety in the sales value. So margin of safety in sales value is just the margin of safety in units times the selling price per unit. So we can write it down as sales in units minus break-even point in units. And this gives our margin of safety in units, right? So now we need to multiply it with our selling price per unit. So that's selling price per unit. Okay, this concludes the second part of this question. Now we can move towards the third one. We are given additional information. At one factory, a single product is made. So this falls under our assumption of break-even analysis, and the following budgeted details are available. So we have the direct materials per unit. Let's figure out the total direct materials. So that's just going to be the total kgs of direct materials times the rate of direct materials per kg. So that's $5. So 3 times 5, that's just going to be 15. So the direct materials per unit is 15. Similarly, let's figure out our direct labor per unit. So direct labor required for 1 unit is 2 hours, and the direct labor rate per hour is $9.50. So we just multiply 2 hours with that value. And this gives our direct labor per unit to be 2 times 9.50, which is 19. Alright, then we are given the fixed cost per month to be 66,000 and the selling price per unit to be 48. And we're also given the sales in units, which is 8,000 units per month. Now we need to calculate our monthly margin of safety in units. Okay, so we just wrote down our margin of safety in units formula above, and that is just the sales minus break-even point in units. Okay, we already have our sales in units right here. That's 8,000 units per month. But we do not have our break-even point in units. So first we need to figure that one out. Let's write down our formula for break-even point in units. That's just going to be the total fixed costs divided by the contribution per unit. Okay, so let's have a look at the given information. We can see that the total fixed cost per month is 66,000. So we can just substitute that value. And we know that the contribution per unit is just the sales price per unit minus our variable cost. We can see that our selling price per unit is 48. So that's 48 minus, now we just need to subtract all of our variable costs. And the variable costs are the direct materials per unit and direct labor per unit, which we figured out to be 15 and 19 respectively. So let's subtract this from our selling price. Minus 15 minus 19. So that's 66,000 divided by our contribution per unit is just going to be 48 minus 15 minus 19, which results in 14. So this gives our break-even point in units to be 66,000 divided by 14, which is 4,715. Now we just need to substitute this value into our formula for margin of safety in units. So that's minus 4,715. Now this will give our margin of safety in units to be 8,000 minus 4,715, which results in 3,285. So this concludes the third part of this question. Now we can move towards the fourth one. We are again given additional information. The directors are concerned that there could be a fall in demand for this product, and they plan to make some changes to reduce the product's break-even point and encourage sales. Alright, first let's have a look at the question. For the fourth question, we need to calculate the decrease in the monthly break-even point in units if these changes are made. Alright, so let's have a look at the changes. So first change is that use a different grade of material, and the list price of this material is 10% less per kilogram than the existing material. Okay, let's figure out the new direct materials rate. So that's 10% less than per kilogram of the existing material. Let's have a look at the above information. We were given our rate for the existing material to be $5 per kg. Now we need to reduce it by 10%. So that's just going to be 5, which is our existing price, times the reduction of 10% can be given by 1 minus 10%, which we can write down as 0.10. So that's just 5 times 0.90, which gives our new direct material cost per kg to be 4.5. So that's per kg. Okay, then the second change is that each unit will require 5% more kilograms of this material. Alright, previously the direct materials required per unit was 3 kg. So now we need to increase it by 5%. Let's do that. So the increment is just going to be 3 times 1 plus 5%, which we can write down as 0.05. So that's just going to be 3 times 1.05. This gives our new kilograms required per unit to be 3.15. Okay. Then the supplier of materials has agreed to give 20% trade discount, meaning that we will only be paying the remaining 80% of the materials because we are receiving 20% as a discount, right? So let's just figure out the total direct materials cost per unit. So the direct material per unit, we know that each unit requires 3.5 kg of direct materials, right? So that's 3.15, and then we need to multiply it with the cost per kg of direct material, which we just figured out to be 4.5. So let's multiply it with 4.5. Now this will give our total direct material per unit, but what we also know is that we are receiving 20% trade discount, meaning that we only pay the remaining 80%. So we will only be paying the 80% of this cost. So we can just multiply it with 0.80, right? So this gives our new direct material per cost to be 3.15 times 4.5, times 0.80, which results in 11.34. Okay, then for the fourth information, we are to make alterations to machinery to improve efficiency at a cost of 24,000. So this will definitely be added to the machinery cost, and machinery is depreciated at 25% per annum. So this increment in the machinery cost should also be charged with depreciation. So let's figure out the depreciation charge for the month, because we are doing it on a monthly basis. So that's just going to be 24,000 times our rate. So the rate of depreciation is 25% right here. So that's 0.25. But remember that this will give the depreciation for the year or on the annual basis, but we only require depreciation for this month. And we know that there are 12 months in a year, so we will just be dividing it with 12 in order to figure out the charge for 1 month. So that's going to be 24,000 times 0.25 divided by 12, which results in the depreciation per month to be 500. And we know that this is a fixed cost, right? So we will also be required to change our fixed cost. So previously, let's have a look above. The fixed cost per month was 66,000, but now we will also have to add this additional depreciation charge. So that's 66,000 plus the depreciation charge of 500, which results in the total fixed cost per month to be 66,500. Okay, for the fifth part, we will also be introducing a sales commission of 0.50 per unit. Since this is a per unit cost, this is a variable cost, right? Which means that our contribution will also change. So let's figure out the total new variable cost. Let's have a look above for our direct labor. So the direct labor per unit remains unchanged, which means it will still be 19. So the variable cost first one is direct labor at the rate of 19 per unit. Then we figured out our direct material per unit. That was 11.34. So let's add it, 11.34. And then we are also given that there is a sales commission per unit, which is again a variable cost, and that's 0.50. So let's add it as well. So this gives our new variable cost to be 19 plus 11.34 plus 0.50, which results in 30.84. So this is the new variable cost. Now for the sixth one, we are given that the selling price is to be reduced by 1.5% per unit. Okay, then let's have a look at the previous selling price. We know that selling price per unit previously was 48. Now we need to reduce it by 1.5%. So that's just going to be 48 times 1 minus the percentage. That's 1.5. So we can just write it down as 0.015. So this gives our new selling price to be 48 times 1 minus 0.015 to be 47.28. Okay, so now we need to figure out the change in our monthly break-even point in units, meaning that we first need to figure out our new break-even point. Right, let's write it down. So new break-even point is just going to be the new fixed costs divided by our contribution per unit. Okay, we already figured out our new fixed cost right here, so that's 66,500. Let's write it down. Then we know that the contribution per unit is just the sales per unit minus variable cost per unit. And we already have our sales value right here, that's 47.28. Now we just need to subtract our variable cost from our selling price, and we figured out our variable cost to be 30.84. So let's subtract that. Alright, so that's just going to be 66,500 divided by the contribution per unit is just going to be 47.28 minus 30.84, which results in 16.44. This gives our new break-even point to be 66,500 divided by 16.44, which gives 4,045.01. And since we're talking about units, we need to round it off. And remember that whenever we're talking about break-even point, we just need to round it off. So we can round it off 1 unit above it, so that's 4,046 units. So So this is our new break-even point, but we are to figure out the decrease in monthly break-even point in units. So the decrease in monthly break-even point in units is just going to be the previous break-even point in units minus our new break-even point in units. So let's have a look above. We already figured out previous break-even point in the above question, and the break-even point was 4,715. Let's write it down. So that's 4,715 minus the new break-even point, which we just figured out to be 4,046. Alright, then this gives the decrease in monthly break-even point in units to be 4,715 minus 4,046, which results in 669 units. Alright, so this concludes the fourth part of this question. Now we can move towards the fifth one. We are again given additional information. At the other factory, monthly production and sales are normally 1,400 units of a different product. Then this product has a variable cost of 65, alright, and a contribution of 17 per unit. The budgeted factory fixed costs are 128,000 per month. Then we are told that a major customer normally purchases 5,500 units per month. However, the company has been informed that no units will be required by this customer in August 2022. And the directors are considering two options. First of all, let's have a look at the question. We need to calculate the profit for August 2022 for option A. Alright, then let's have a look at option A. We are to reduce production in August 2022 by 4,000 units. So that means our total units will be reduced. So previously it was 1,400 units, right? Now we just need to reduce the production by 4,000. So let's subtract it. So this gives our new units to be 10,000. Alright. Then we also need to run an advertising campaign at the cost of 2,200 to increase demand so that all production is sold. We can see that this advertising campaign does not depend on the per unit cost, which means that this is actually a fixed cost. So let's figure out our new fixed cost. That's 2,200 plus the previous existing fixed cost of 128,000. So that's 128,000. And this gives the new fixed cost for option A to be 130,200. Now we just need to figure out our profit on these bases. We can see that we are not given any information regarding the sales price, but we are already given the contribution. So we can just start with our total contribution. Let's write it down. So, okay, we'll start with total contribution. And total contribution is just the contribution per unit times the production units, right? And we can see that the contribution per unit is 17 and the total units produced is 10,000. So we just multiply these two units. So that's 17 times 10,000, which gives the total contribution to be 170,000. Now we just need to subtract our fixed costs. And the fixed cost for option A, we already figured out above. That was 130,200. So let's subtract this value. That's 130,200. And I'm going to put it in bracket, indicating that this needs to be subtracted. Now this will give our profit for August 2022. And that is just the sum of these two units. So that's 170,000 minus 130,200, which results in the profit for this month to be 39,800. Now we can move towards the second option. For the second one, we need to calculate the profit for August 2022 for option B. So let's have a look at our option B. We will be continuing with normal production in August. So that means the units is going to remain the same, which is 14,000 previously. So that's 14,000. Then store 5,500 units in a warehouse at a cost of 6,000. So this cost is not relating to per unit, right? Which means that this is a fixed cost. So let's figure out our new fixed cost. That's going to be 6,000 plus the existing fixed cost of 128,000 per month. Let's add it. So this gives our total fixed cost for option B to be 6,000 plus 128,000, which results in 134,000. Alright, then at the end of August, an overseas customer will purchase all the units in the warehouse at a special price of 70 per unit. Okay, so the selling price for these 5,500 units is 70. Okay, we have the total units of 14,000, right? So then out of 14,000, 5,500 units are sold at the price of 70, meaning that the remaining units will be sold at the contribution given above, which was 17 per unit. So let's subtract the 5,500 units. So that gives our remaining units to be 8,500. So for this 8,500 units, nothing is changing. So the contribution per unit is going to remain 17. Okay, then transportation cost of 1.80 per unit will be incurred on these units. So let's figure out our contribution for this 5,500 units. That's just going to be the sales minus our variable cost. And we can see that the selling price is 70. Now we just need to subtract our variable cost. And we can see that the transport cost is per unit, which means that this is a variable cost. So we need to subtract this as well. So that's 1.80 minus, we already have our existing variable cost given above. So that was 65 per unit. We also need to subtract that value. So this will give our contribution per unit to be 70 minus 1.80 minus 65, which results in 3.20. Okay, so we have two different contributions, one for our 8,500 units and another for our 5,500 units. And the fixed cost is obviously the same for both units. Alright, with these information, now we can figure out our total profit. Okay, let's figure out our contribution for 8,500 units. So for 8,500 units, our contribution per unit remained same, which was at $17. So let's multiply it. And this gives the contribution to be 8,500 times 17, which is 144,500. Now we need to figure out the contribution for 5,500 units. And for these units, we figured out our contribution per unit to be 3.20. So let's just multiply that as well. Now this gives the contribution to be 5,500 times 3.20, which results in 17,600. Now we can add these two up and figure out our total contribution. So the total contribution is just going to be the sum of these two amounts. So that's 144,500 plus 17,600, which results in 162,100. Now we just have to subtract our fixed costs. And we already figured out our fixed cost above. That was 134,000. So let's substitute this value. That's 134,000. And since this needs to be subtracted, we need to put it in a bracket. Okay, now we can easily figure out our profit for August 2022 by subtracting the fixed cost from our total contribution. So that's 162,100 minus 134,000, which results in the profit for August to be 28,100. Alright, this concludes the fifth part of this question. Now we can move towards the sixth one. We need to advise the directors which option they should choose. We need to justify our answer by discussing both financial and non-financial factors. Alright, let's have a look at the profit. We can see that the profit for option A is 39,800, whereas the profit for option B is 28,100. And in this case, the profit is obviously higher for option A. So let's write it down. We can say that option A produces a larger profit as compared to option B. Then we know that option A will only produce that profit if the advertising campaign works, right? Because we are running an advertising campaign. So there is no guarantee that this advertising campaign will actually work and result in the higher profit, because this is just an estimate for the future, right? So we can question that as well. Will advertising campaign be successful. Similarly, for option B, we are told to store 5,500 units in a warehouse, right? But what if the goods will deteriorate in a warehouse? We do not know that, right? So we can question that as well. Will goods deteriorate while stored? Okay, similarly, we know that the total production units is being decreased for option A. We are decreasing the production by 4,000 units. Does this mean that the workforce will be affected? Because since they do not need to produce the usual 14,000 units and only the 10,000 units, will some workforce remain idle, right? That's a question. So we can write it down as well. Effect on workforce of reduced production in option A. Similarly, for option B, we are producing 14,000 units, right? But while selling them, for the 8,500 units, we are selling it at a contribution of 17, whereas for the 5,500 units, we are selling it only at a contribution of 3.20. Meaning that the sales price for this 5,500 units is obviously way less than that for these 8,500 units. So we can say that there is a reduction in selling price, right? So this reduction might infuriate some of our existing customers because we are charging them a higher sales price than this sales price of 70. So they might also demand a lower sales price, right? That's an effect as well. Let's write it down. Effect on existing customers of offering special price in option B. Alright, now considering these factors, we need to make a proper decision. So personally, solely on the basis of profit, I would go with option A. So let's write this decision clearly. What we can write is that the directors should choose option A. Alright, so this concludes the sixth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.